Hello, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. This is for Friday, June 17th, getting ready for Monday, June 20th, 2016. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. We would love for you to subscribe to this, so if you want to, please go to the button below and subscribe. This is some great information here, and you'll definitely want to have it coming to you every single week automatically. This is a video blog, and it kind of corresponds with the text blog located at the Discover Options blog. You can go to our website, www.discoveroptions.com. Go to the blog link. That'll take you to Frank Fahey's blog, The Prepared Mind, and some great volatility information as well as double calendar opportunities. Just a world of great ideas there. Finally, before we get to our two reports, which was the Condor Butterfly Timing Report and the S&P 500 Directional Likelihood Report, I want to point out that you can get a free ebook at discoveroptions.com. Excuse me. You can go to the link in the upper right and click there, but it's available at the OptionView website as well. We're going to do two reports here today, the Condor and Butterfly Timing Report, followed by the Directional Likelihood Report. First, to the Timing Report. We're going to go over why this report is significant. I'm going to go over the methodology and then the current market condition and edge level. Let's say that you are an advanced options trader and you like to trade condors and butterflies and collect time decay benefits every single day in what amounts to what could be a regular monthly income, as is often proposed by many educational sites. And let's say you were sitting there on December 31st with some cash ready to invest in a position, and you take a look at the chart and you go, boy, it's been chopping around pretty good. Be nice for it to continue. Well, if you went through the Condor and Butterfly report, the timing report that I'm going to show you how we do this, at this particular day, we would have had a minus 4.2% edge, a negative edge. And I'm going to tell you exactly what that's about for those of you new. But indeed, after that particular day, the market didn't do so well. At this time, there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. That's what the negative edge was saying, that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. That's not good if you're selling premium neutrally like condors and butters. And in fact, the market just took off to the downside, and this would have been a very, very difficult environment to sell premium in, of course. So that's why we do this. It's been my quest for years now to come up with a timing approach to help the condor and butterfly folks like you and me to do this better. So here's the current condition today after Friday's close on June 17th. And we see here a few things. Thursday was a downswing day. Friday then was just barely an inside day. The high was not as high as that of Friday, and the low was higher than Thursday's low. Or Friday's high was lower than Thursday's high. So it was an inside day. All right. This took place in between the 20 and the 100-day moving averages. All right, and in the stochastics, the 15-3 stochastic, it was down there at about 28, so I just bracketed between 10 and 50, and it was underneath its 3-day moving average. So that is a specific market condition that's kind of unique. In fact, going back to January of 2000 up to today, this condition, as I described on the right side of the screen, has only occurred 44 times. 44 times in the past. So this condition, though, here's the question on the table. Is this current condition a good one for selling option premium from a neutral standpoint? Now, here's our methodology. Here's what we do. I first look at how much a market has moved, the S&P, how much does it move for from a given close for the following 21 days. So I've created this indicator here. And let's just take it on the far right side of that indicator down there from, what, April 28th or something. The close was at 2076, and so for the next 21 days, how far did the market move? What was the maximum amount it moved, either up or down? And in this case, you could go to that low down there, and it moved about 50 points. Roughly 50 points, which turned out to be about 2.4%. Now, if you go to that indicator I created, you'll notice, if you look at the scale on the right, that's sitting there at 2.4%. Now, the follow-up question to this is, on April 28th, what was the option levels implying? What volatility level was implied by the option prices on April 28th? And so we go to the VIX, we crunch it through an algorithm, and there's the question, okay, what was being implied? And when you graph the VIX and the implied move from the VIX, you have about 4.4% was the implied move. So in this case, the options were implying a move greater than what actually took place. Okay, that is a good environment to sell premium in. In fact, wherever you see the blue line VIX above the actual move, that in hindsight turned out to be a good environment to trade premium in, and we would color those bars blue or label them favorable days. Favorable days. And so what we do then is we label all the bars either red or blue, favorable or unfavorable, and we start finding that there are some predictability parameters here regarding favorable and unfavorable bars. It certainly isn't 100%, but there's some things we can do to tell if a bar is going to end up being more likely to be favorable or unfavorable. All right, and so that's what we do with the bars there. So what we want to do to get to that predictability is we're going to measure two things. All right, what percentage of all the bars going back are favorable and unfavorable? Then we take that number and set it aside. Then we take all the bars that match our current market condition, all 44 of those bars, and we look at what percentage of those in the past were favorable or unfavorable. And if there's a big difference between the broad market going back historically and just the bars with the current condition, well, there might be an edge. If we go back and find out that all 44 of those bars that match our current condition, what if 100% of them turned out to be favorable? Okay, that would mean that today's current condition on Friday, very good likelihood that it also will end up being a favorable bar, and you could really go aggressively with the condors and butters, right? What if it is 100% of those were all unfavorable, that 100% of those 44 bars, it turned out that the market moved more than what was implied by the VIX? Okay, if all the bars were red in the past, well, then you probably would want to back off and probably not do any butters or condors at that point. Perhaps take some directional shots or something. Okay, so that's what we're going to do. Let's first look at historically what percentage of the bars going back to Jan of 2000 are favorable. And as it works out, when you crunch the numbers, roughly 65% of the bars are favorable. Pretty much almost 2/3, 1/3 is a good rule of thumb. In the S&P 500, 2/3 of the bars are favorable, 1/3 of the bars roughly are not favorable. 65-35 in this case. So that's historically the benchmark going in the past. Now, let's go to our condition of the bars which match our current condition. What percentage of those were historically favorable for premium selling? Again, our current condition is kind of unique. An inside bar doesn't happen all the time, right? So we take that into account, and the fact that we're in between the moving averages and in a very unique spot on the stochastics. Of those 44, 56.8 were favorable. 43% were unfavorable. So what this translates to is a negative edge. A negative edge. Historically, we have about 64.8, okay, of the condition bars, 56.8. About an 8% variance there. 8% difference. So what this means is that there's a higher than usual likelihood that the market will be more volatile than what is implied by the option prices. Does it mean that the market's going to take off and get wild and crazy? No. It means that there's a greater likelihood than normal that it will. That's all it's saying. And so for those of us that have been doing this a while, and I know many of you have been at this a while, we play the probabilities. So what we have here is a probability. There's a higher than usual probability that the market will be not favorable for premium selling. Doesn't mean that it will work out that way. Okay, but at least we're looking at a market condition. We know that we're looking at a market condition which is more, there's a higher than usual likelihood that it'll be more volatile. So that's the timing report. Okay, let's go to the directional report now, the directional likelihood report. But first, I want to make sure you know you could go to discoveroptions.com. We have a full array of one-on-one mentoring opportunities for you. Whether it's if you're just getting started in options, or whether you want to trade earnings, or whether you want to get full-blown into trading the indexes from a market neutral perspective, looking for that regular monthly income from premium selling, or perhaps if you're a futures trader and you want to get into options on futures, we have a full array here. You could get it at any price point and test the waters. We'd love to have you aboard. Okay, I'd love to have you. We're starting at $99. And that gives you a couple mentoring sessions even. Okay, so let's go to the likelihood report. Let me show you this. We again start with our current market condition that you're already very familiar with. And here's the question here in this case. Since Jan of 2000, how often has the same condition occurred? We know it's occurred 44 times. Of those 44 times when those occurred, what direction typically did the market go? What was the distribution of prices after each of those 44 times? And does it lean bullish or bearish? That's what we want to know here. And so here's how we do it. We look at I do this from a price distribution perspective. All right, a broad distribution. So I look at the historical distribution of price. I then look at the distribution after our condition develops, and then we compare the two. So how do we determine the broad definition, the broad distribution of price? All right, I do that by taking volatility bands. We measure by observing how often price touches one standard deviation volatility band that are placed from each bar's closing price. I do this in 5, 10, and 15-day intervals. One standard deviation from the close, and I'm using the 20-day historical volatility level to determine the width of those bands, and these are of course log normally distributed. So here's just an example. Here's a 10-day band set up and above and below the close. So here's what we do. We go here, and I'm going to look at this upper band and draw that. You know, here's the deal. I'm using my laptop's mouse pad, and it is just difficult as heck. I'm traveling now, and I have a little, I usually have a normal mouse I attach to the laptop. I'm going to try this one more time. So here's the upper band, and we draw the band going forward 10 days. And here's the question, does price from here go up and hit the upper band, go down and hit the lower band, if I can get it to work? Nope, that didn't work. Or does it wobble in between? So let me do this, pull this out, perfect. Or does it wobble in between? Okay, and so we look at this, just a second. Click, boom. Clearly it went up and hit the upper band. From here, in the next 10 days, did it go up and hit that upper level? In this case, yes, it took a day before it hit that upper band right there, you see. Okay, now from this close here, did the market go up and hit this price point, go down and hit this price point, or did it wobble in the middle? Okay, let's go over here. Boom. And clearly it wobbled in the middle. It tried to go down and hit this point, you could see, but it failed to. So in this case, it hit neither. So for this particular close, we record in our database that it hit neither of the bands. hit neither of the bands. We do this then for all the closes going back, all 4,100 closes. We record that, and we record how often they struck the upper 5, 10, and 15-day bands. These are the 10s you're seeing here, but I do it in 3 different time frames, 1, 2, and 3 weeks. Okay, so here are the stats. Going back 4,132 bars, on average, the market hits the upper 5-day band. Look at that, 29.4% of the time. Okay, the upper 10-day band, 23%. Upper 15, about 23%. The lower 5-day band, 30%. Lower 10-day, about 30%. And the lower 15, 32%. So, okay, so that is the standard distribution. That's the historical distribution of prices going back to Jan of 2000. And since then, we've had a fairly equal distribution between bullish and bearish markets. I think it leans a little bit more that we've been in a bull market a little bit longer than the bear in that case. Now, let's do the second part of this. Understand the distribution after our specific technical scenario develops. And it hasn't happened that often. It's only happened once in the past several months besides Friday. And there you could see I marked it. And we're going to look at the distribution here as, excuse me, moving forward as of the close on Friday. What happens if Monday the price goes above the high? What's the distribution if it ascends above the high? And what's the distribution if it ascends or descends below the low on Friday? I want to understand the distribution of all of those scenarios. I think that'll give you some little bit better insight going into Monday's open. So let's look at as of the close. As of the close of those 45 signals in this case, 45. Okay, price hit the upper 5-day band 33% of the time, which is a little bit higher than historical. The upper 10, it hit 40% of the time. It hit the upper 10, and it hit the upper 15 31% of the time. Look at that. So it hit the upper bands a strong level above the normal historical here. So this indicates a bullish bias. It struck the lower bands a little bit less, a tiny bit less, not much, but a tiny bit less on the downside. So this is showing us a bullish leading in the distribution, looking at the condition that we have. Now let's look at what happens if on Monday price exceeds Friday's high. Again, look at this. It goes up and hits the upper bands a lot more often than historically, and it strikes the lower bands even less often than at the close. So it looks like if it exceeds Friday's high, there's a much greater likelihood that we'll end up having a bullish run. The prices in the past have been distributed in a bullish fashion. Is it guaranteed? No. It hasn't struck those upper bands 100% of the time. Even then, there's no guarantee. We all know that. But we're just playing the likelihood game, the pure probabilities based on the past. Let's look at Monday if it goes below the low. If it goes below the low, still it hits the upper band more often. Look at that. It hits the lower band a little more often as well. So this is telling us if it goes below the low on Friday, we're looking at a bit more volatility. It historically has struck the upper and the lower bands more often. Interesting. So, bullish bias throughout. If it goes below the low on Friday, you're looking at a likelihood of greater volatility than in the past, certainly. Okay, very interesting. What's this one? So what I do now is, when I did this, I drew the bands using statistical volatility from the last 20 days. Here, I'm going to redraw the bands using the VIX, and I'm going to skew adjust the VIX so that the upside volatility is lower than the downside. Because usually when the market moves down, it goes down at a greater volatility than when it goes up. And I take the SIBO skew value and run it through the VIX and just have an algorithm that does that. And I come up with 2 different volatility levels. And then I redraw the bands. Now the VIX is higher than statistical usually. So what that means is the bands are a little farther out, and they're going to therefore be harder to hit, and they're going to get hit less often. And so you could see the historical distribution is a bit lower than using statistical. And at the close, the pattern still holds true. The bands are getting struck more often than the historical of these 45 signals, and they're striking the lower bands less often than that. Let's look at Monday. If price exceeds Friday's high, holding to pretty good, well, the same situation, that the upper bands get struck quite a bit more often, lower bands less often. And if it goes below the low, see here, if it goes below the low, the upper bands get struck, 2 of the 3 get struck more often, the lower bands get struck less often across the board. Here are the volatility levels. Statisticals at 10.2. And then I'm going to show you some ideas, just one little idea. If you like the bullishness of the condition we're in, and you really want to sell premium in a certain fashion, here's an idea: a bull put spread. I'm going to call this a hedged bull put spread. A hedged bull put spread. Here's the VIX at 19.4. I crunch it through the skew, the SIBO's skew value. The upside VIX is at 15.3. I have my own little downside VIX calculated at 23.1. So what I'm going to do is take this 23.1 and run it through Option View. I'm going to go to Option View's statistical volatility button up there, plug that in, and then if I go out to the July expiration 26 days from now, July 15th, not quite a 30-day number, but we're out here at about the 1940 mark to sell premium in a bull put spread. Then we come up here to the at the money, and we buy a bear put spread to hedge it. We make sure that we have a net credit coming in, and when you crunch this through Option View's graphic analysis, you can see that if the market goes down, we have the hedge kicks in, and if it goes to expiration, we can make up to 22% or so on our money. If it strikes the short strike here, we'll lose about the same amount that we're trying to make if it goes down on this side. Now, if it goes up, which would be okay too, we'll make about 5% on our money within 26 days. So when you then look at the Option View's price graph, and you use the little birdie button up here, it's this button right there, you'll see here that we make money in the green region, which it's certainly possible that this trade would not make money, but if the market certainly goes bullish or wobbles around at all, it looks like this would be a decent trade to consider. Remember, if it goes down in this region here, this is where we'd make 20% or more. So we wouldn't mind it going up, though, just giving us some better ease of mind and get our 5%. Folks, I enjoy this. Thanks for joining us. I'm Steve Lentz with Discover Options. Give us a shout. We'd love to have you subscribe and also test the waters for mentoring. Take care. Have a great rest of the day. Bye-bye.